morning, everyone. Thanks very much for joining us this morning. We're going to leave it just a minute or two to let people join before I kick off with Max Ormiston for an update on the Outstanding British Companies Fund. Really pleased to be joined by Max this morning, and thank you all of you for dialing in as well, or for watching this on the content library. One piece of housekeeping before we get started. This call is for professional investors and eligible counterparties only. Any views expressed in this communication are those of the fund manager and are subject to change without notice. They are not necessarily the views of Unicorn Asset Management and do not constitute investment advice. Your capital is at risk. Past performance is not a guide to future performance. With the housekeeping out of the way, really pleased to be joined by Max this morning. Max, I think if you're just on mute at the moment. Yeah, perfect. You're not anymore. We're going to have a look for about 15 to 20 minutes at the Outstanding British Companies Fund. Max is going to give a bit of an update on the portfolio, on performance, on attribution to the different moving parts within the portfolio over the last 12 months, and a bit of a view on the outlook for the fund and the UK in general, before we open up to questions. If anyone has any questions, please put them in the Q&A box at the bottom center of the screen, and we will come to them if we haven't answered them throughout the body of the update. Enough from me. I will hand over to Max, and I'll be back at the end.
Good morning, everyone, and thank you, Alistair, for the introduction. So, as Alistair says, I think it's worth just recapping a few points on the Outstanding British Companies Fund for perhaps those people who are new to the fund, and also for people who have been long-standing investors for us. A few points on the slide there. I mean, the three I'd really pick out from our perspective. The companies within the portfolio remain very well capitalized, strong balance sheets, with just over 50% of the companies having net cash on the balance sheet. Volatility of the fund remains low. It's the lowest in its sector since inception, and we're also pleased to report that volatility throughout 2020 was also in the top quartile of the all company sector. And finally, the correlation, as you might expect given the constituents of the portfolio, remains low relative to the sector. So all in all, we think the fund's in a good place, delivered strong relative outperformance since inception, and in good shape to grow over the next few years. So over the slide, you can see without dwelling on it, the long-term performance of the fund, just on slide 4 there, versus the IA sector. So I think just picking up on really the fund, from our perspective, has delivered on what we set out to do. It's acted more defensively during periods of market volatility, and we saw that in March 2020 last year, when the fund declined by less than its peer group sector. And on the way up, we hope to capture as much of the upside in the rally as possible, but perhaps we will lag the market when there is a very strong, sustained rally in sectors which we don't own, and we'll come on to that in the next few slides. So just turning on now to the short-term performance, it's fair to say, 2020 was a challenging year for the fund, particularly the final quarter, as you can see by that chart. The fund performed as we would have hoped through the first 3 quarters of the calendar year, and as I mentioned earlier, protected investors well on the decline in March. But once we entered the final quarter, and there was the announcement that a vaccine was on the horizon, we saw this significant shift away from quality and more highly valued growth stocks, and a real recovery in the value and say, bombed out sectors which had suffered so much during 2020 because of the economic lockdown measures. And the recovery was quite stark. So we saw this very strong value outperformance during the final quarter of 2020. And of course, those funds which had exposure to sectors such as the high street banks, as well as some of the commodity related areas of the market, so oil and gas, performed well with the oil price recovering, and the mining sector also performed well, which for investors in the fund probably know aren't areas of the market we're invested in. And so it was a real challenge for us to keep pace with the market during that final quarter. So it was slightly disappointing end to the year, to be honest. But as I said earlier, we haven't changed the method in which we manage the portfolio, and are really sticking to what we do, looking for those quality businesses which we feel will outperform over the long term, and we expect the value that those companies to be reflected in due course. So I think just turning on to the attribution, we can pick up a few points. I think I've covered most of the review of 2020. I think it's fair to say, though, I think the second bullet point from the bottom shows, just pointing out the relative underperformance until the end of October. But there were a number of investee companies in the portfolio which performed really well. So our exposure to the healthcare, technology, and some of the high quality engineering companies which we've held for several years in the portfolio all posted very strong returns over the year, and really pleasing to see that. And perhaps that was lost a little bit in the general market movements that we experienced in the fourth quarter. The other final point I'd make on that slide is the decision which we took last year to gradually rotate the fund out of the smaller, less liquid AIM-listed companies with a market cap below 100 million, and reinvest the proceeds further up the market cap scale in constituents within the portfolio, thereby improving the liquidity statistics of the fund, which as the fund has grown has become more relevant. Now it's around 130 million in total assets within the fund. So for us, taking into account our liquidity restrictions, whereby we won't own more than 5% of a listed company's assets, we are continually monitoring and seeking to progressively improve the liquidity within the portfolio. So as I said earlier, the fund underperformed the sector and the benchmark, principally because of the exposure, or I should say lack of exposure to these sectors we don't own, the oil and gas banks, which performed well over the calendar year as a whole. And on the other hand, we underperformed because of our lack of exposure to the mining sector, which we also don't own, and that cost us over 2% in relative performance terms. Finally, there were a couple of poor stock performances within the support services sector, which cost us around 2%. So just flicking on now to the actual discrete contribution to return. As I said, the real strong performances came from long-standing constituents within the fund, the likes of Renishaw, which is a global market leader in precision metrology equipment, as well as our investment in Tristel, which is a provider of disinfectant products, principally for medical device use, and also antibacterial wipes, which enjoyed very strong demand through 2020 in hospitals around the UK as well as overseas. That business is in really robust shape now. It's grown its international arm significantly, so they now account for a significant proportion of its sales, and it's a business which we've known for a long time, having invested within the VCT a number of years ago and subsequently added it to the outstanding British companies fund. Finally, Integrafin, you may know better as the Transact platform provider, highly regarded within its space, market-leading platform for investment, and has continually delivered solid and robust growth in client assets and therefore fee income since it listed on the market 3 or 4 years ago now. And so I think the resilience of those businesses really just came through for us, and it's encouraging to see, the strength of those performances. On the other hand, the portfolio did have limited exposure to, or I should say, modest exposure to the consumer sector, principally our investments in the City Pub Group in Shaftesbury, which came under pressure last year. Shaftesbury owns the estate in West End of London, which has been very severely affected by the lockdown measures and the lack of tourists, international and domestic, which London has experienced over the past 12 months or so. And as a consequence of that, we took action and exited the investment last year. We've also been gradually selling down our holding in City Pub Group, which was also negatively affected by the enforced closure of the pubs. The primary reason for selling City Pub Group is really to do with the liquidity and size of the company. So as I mentioned earlier, as the fund has grown, it's become increasingly difficult for us to maintain some of the smaller and less liquid stocks within the fund. And we've therefore exited City Pub Group, capturing some of the more recent rally in the share prices. That reopening and improvement in investor sentiment has led to a recovery in the share price. So we finally exited the last of our holding in last month in February. Just turning on now, I think it's worth just touching a little bit on Unicorn's ESG policy. I don't want to dwell too much on it. It's not as you're well aware, it's not an ethical fund, so we don't focus exclusively on ethical investing within the fund, but ESG has become a very important part of what we do at Unicorn. We are now signatories to the UN Principles of Responsible Investment, and we have appointed ethical officer, who's my colleague Alex Game. He's worked alongside Fraser McKersey and Simon Moon on the ethical fund since that was launched, and his mandate has now been expanded to cover Unicorn from an ESG perspective. So we have now our formalized responsible investment policy, which is available on the Unicorn website, and we have now introduced our ESG monitoring process across the Unicorn OEIC funds, whereby investments are reviewed and either approved or rejected by the ethical officer. We are working to introduce an ongoing monitoring system, which will help us to improve the ESG or the quality of the ESG data, I should say, which we're looking at. As I'm sure many of you are aware, ESG is a more challenging aspect for the smaller companies within the market, who perhaps don't have the depth of resource within their companies to report and monitor on ESG. But we do feel we're in a strong perspective, as we have very regular and close relationships with meetings with company management. And so we're able to engage with them on a regular basis and help them to best explain what they're doing to meet ESG within their company. And as I said, it's an area which we feel will become increasingly important over the next months and years ahead, and will be more fully integrated across the Unicorn fund range going forward. So just turning on now, there's a case study which we've included. British American Tobacco comes in for a lot of stick for investors from an ESG perspective, given its widespread knowledge and acceptance that smoking is harmful and to people's health. And we've fielded questions on this from the perspective of the fund for from several areas. And from our perspective, British American Tobacco, it meets or demonstrates significant qualities which meet the fund criteria. So principally that sustainable and consistent growth in revenue, profits and cash flows. As I mentioned earlier, it's also reducing its levels of debt, and so it's improving the strength of its balance sheet. And we feel at current levels, the shares just don't reflect the quality and strength of those earnings. It's fair to say, I think this is a company which has to some extent, fallen out of favour with investors, and perhaps investors are less willing to hold a company like British American Tobacco, given the perceived ESG risks. But from our perspective, this is both reflected in the current valuation, which you can see there is valued on a P multiple of less than 8 times, and with a dividend yield of over 8%, which we feel is covered by cash flow. So not only is the company near an all-time low in valuation terms, but we feel is also making or taking a number of steps to improve investor concerns over its ESG policy. The principal one, of course, being the shift towards non-combustible products and the new product categories, whether that's vaping products or heated tobacco products, which over the next few years will account for almost a target of 20% of their group revenue. Secondly, the company is also taking a number of steps to improve its environmental concerns, such as using recyclable packaging and fewer plastics. And so it's well aware of its actions that it's taking and the way it can address investor concerns over ESG complaints within the company. So for us, it's been a long-term holding in the fund, and at current levels we think is attractively valued and not really fairly represented amongst institutional investors. So just moving on now to the next slide, we've got a few company updates here, which I think I'll touch on. I mentioned at the start of the presentation, we feel that perhaps to some extent, the long-term holdings within the fund, they're all making really good progress, evolving their businesses and continuing to grow. And perhaps that wasn't completely reflected last year, given the wider macro economic headwinds. So, for example, Mattioli Woods is a leading provider of wealth management and pension services throughout the UK. This is a business which we've held for a number of years now. It's continued to successfully grow client assets, and you can see that it's now up to a record level of over 10 billion in client assets. They've grown through predominantly organic and also made a small number of bolt-on acquisitions. This is really a business which is run with the integrity of both its clients, its staff and the shareholders, and is in a really strong and sustainable place to deliver growth over the next few years ahead. Secondly, Renishaw is a business you might know well. It's recently announced that its founders, who've been with the business now for a number of decades and still own 50% of that business, they've now are in their 80s. And sadly for us, it's a position where they're looking to exit the business and have expressed their preference to dispose of the company as a whole. So we feel, the risk is, or I should not say the risk, but the challenge will be that it could be a case of another business or a global market leader exiting the UK market. And as I mentioned earlier, it's provides market-leading metrology equipment, and is really ahead of its time in additive manufacturing as well. So if it does go, it will be a loss to both the UK market and to us as shareholders in the business. But it's somewhat inevitable, given, as I said, the age of the founders and the size of their shareholding in the company. So for us, we're maintaining our holding. We will see what offers come in for the company, but we expect this to be very highly valued, given the technology within the company as a whole and the quality of its assets, which it's developed over a number of decades now. And finally, Smith & Nephew is a large global healthcare business, released its results the other day. This is a company which has suffered somewhat in the short term due to the reduction in medical procedures taking place in hospitals, as hospitals have been somewhat inundated with COVID related patients, obviously. So the results in the short term have been impacted by that weaker demand, but we fully expect demand to recover in that business over the next few months and years. As I'm sure many people are aware, the waiting list now for hospital backlogs are significant, and people are still going to need to have their hips and knees replaced and various other medical procedures, and that demand's not going to go away. So there's going to be, we feel, a very strong recovery in their end markets over the next couple of years. And it's a holding we've been adding to in the portfolio. Three more examples here for you, just to round off. Integrafin, I mentioned earlier, has had another strong period. It's increased its net client assets on under administration, and in our mind remains a market leader in the investment platform for the B2B market. Tristel, you can see there, it's delivering revenue growth at the top of its range, double-digit revenue growth and very strong margins. Excitingly, it's also continuing to invest in its US project. So it is an innovative project in the US, which requires a special submission to the US FDA, and they're continuing to work with the FDA and submit their studies for approval, which will hopefully over the course of the next year or so enable its products to enter the US hospital market, which could be transformative for the US business. And finally, Decra Pharmaceuticals. I don't know if any people have purchased a dog during lockdown, but there's plenty more around where I live, and I think that's a trend we're seeing over the world as a number of people have adapted the way they're living and working at home, as it were. All of these animals, of course, over time will age and will require expensive veterinary bills. So, for us, Decra is a really key holding there, global market leader in the veterinary market, both for companion animals and for farm production animals. And they're continuing to expect strong growth, both in the Europe and the US and South America region. So, for a very well-placed business and genuine market leader in what it does. So just providing a brief update on the outlook. There are a number of headwinds which have been in existence now for several months and years. COVID, Brexit, more recently the prospects of inflation and higher taxation are all coming through, and they do represent challenges to UK equity markets and corporate profitability. I think the budget, from our perspective, was at this stage a fairly friendly approach from the Chancellor to try and tackle the challenges of repaying what's become a very large bill to cover the COVID crisis. And the key factor there, of course, being the increase in the corporate tax rate from 2023, which could have we feel, a larger impact on profitability and dividend cover, principally for larger companies. With outstanding British companies portfolio, we're very confident that the businesses we invest in are very profitable and have good levels of earnings and dividend cover, so should be less significantly impacted by changes in the tax rate. Secondly, the outlook in the short term, at least, is in our mind for potentially a very strong and vibrant recovery in the latter half of this year as lockdown restrictions are eased, and sort of we see this pent-up demand from people being stuck at home, looking to go out and socialize again. And you could realistically see a very strong recovery in the sectors such as the hospitality, the pubs, the restaurants, the bar trade, which was so severely affected last year by the lockdown measures. So in the short term, at least, there is the realistic prospect that those businesses will continue to perform well. But we are mindful that longer term trends, such as the potential risks of rising unemployment and higher inflation, will weigh on consumer demand over the long term. So from our perspective, it's something we are mindful of, and will be maintaining what we typically have as a low profile to, or low exposure to, consumer businesses within, or travel and leisure businesses certainly within the portfolio. And you can see at the bottom there, that does mean that if there is a sharp short-term uptick in the value, the bombed out sort of retail type businesses, a continued period of relative underperformance is quite possible. However, from our perspective, investing in what we believe to be the highest quality businesses on the UK market, these are companies that will still be there in the months and years ahead, regardless of what happens over the longer term, and will still be in a robust and resilient position. So, very excited for the longer term prospects of these businesses.
Max, I'm just going to jump in, conscious of time. Got a couple of questions from people to just to put to you. I'm wary that we're catching up with Peter Walls at midday. Two questions which I'll put together as one. One is, are you seeing lots of opportunities for investments in the UK? And the second is, will you partake in IPOs?
Yeah, I mean, both really interesting areas. We're definitely seeing more activity in the IPO and listing market. Within the Outstanding British Companies Fund, we tend to participate less in IPOs, particularly if they're new companies to the market. So we prefer businesses which have a long-term track record of activity and listing. So, as I say, less likely to participate in some of the IPOs, but if something attractive does come along, we do, of course, give it a full attention and consider it for inclusion. And secondly, in terms of opportunities, there are a number of companies which we are monitoring and we feel really exciting or potential prospects to the portfolio, and perhaps where we've been restricted in the short term on valuation. We've seen over the past couple of weeks a little bit of softening in those growth names, and seeing opportunities to add those to the portfolio. So yeah, very excited about some of the the high quality growth names which could be added to the portfolio.
Great. You almost predicted my next question that had been asked, which is about valuations. This fund has always been willing to pay a above market valuation for really high quality businesses. Obviously, there's been a lot of focus on kind of valuations. In terms of the market in general, how are you finding company valuations? You sort of touched on it briefly there, but can you expand a bit more on how you're seeing valuations in the market and also for your companies?
Sure. So as you say, the Outstanding British Companies Fund has always represented a premium to the wider market, and we're not afraid to pay what we consider to be a fair price for a stake in a really high quality company. So currently at the minute, the average PE ratio of the fund is over 20 times, around 22, 23 times PE, and that represents a premium to the wider market. As I've said, there are a number of very high quality businesses which were or have been trading at all-time high valuations, and where we haven't been comfortable to add positions to those companies in the past. We are seeing a little bit of softening in those valuations, and that's providing us with opportunities to reassess perhaps a stake in a really high quality business which ticks all of the criteria, but we just didn't go for before because of that very high valuation. So, as I said, we're looking for a really high quality company and prepared to pay a premium for it, but a realistic valuation rather than some of the very stretched multiples which we have been seeing to some extent, particularly in some sectors of the market which benefited from the stay-at-home trend, the technology businesses, etc., which are all trading on very, or have been trading on very high multiples. I think the only other quick point I'd make is from the perspective of some of the the value stocks, at least in the short term, I think the strength of that recovery has been so strong. Perhaps one could say that the valuations of some of the so-called value stocks have become a little bit stretched in the short term, and we're mindful that until we see the full strength of the economic recovery come through, it will be quite difficult to gauge the strength of that earnings growth in some of the cheaper parts of the market. So from our perspective, really sticking to the quality names and that we hold in the portfolio.
Right. Thanks, Max. That all makes good sense. Look, that's the end of the time we've got this morning. Thank you for watching, or thank you for watching this video on the content library if you're not with us live. Any questions that you have that you'd like to put to any of the team, please do get in touch with your contact at LGBR Capital, and we'll be only too pleased to set something up for the future. Otherwise, that's enough from myself and Max on the Outstanding British Companies Fund, and I'll be moving on to look at the Master Trust Fund with Peter Walls. So thank you, Max.
Thank you.